Good morning, ladies and gentlemen. A very warm welcome from the German-Irish Chamber of Industry and Commerce. We're here today to have a webinar, and you see on your left-hand side our speaker, Christian Keller. Good morning, Christian, who is ready. Good morning, who is ready to go. Just before we start, a few words of introduction. Today we have more than 100 people joining us, so you're all very welcome. Thank you for visiting us. We have people from Ireland, from Germany, from UK, and from other countries in Europe. A big thank you goes to Barclays Bank, to Christian, to give us time this morning, and to Jasper Hanebut, one of our councillors of the German-Irish Chamber. Jasper is in a leading position in Barclays Bank in Dublin, in the European head office, and is with us. So hello, Jasper, and thank you very much for getting this webinar started and bringing us together. Most of you know our webinars now over the last couple of months. Just few to name coming up in the future, in the near future. One is on the 1st of June, we have Gerald Crockwell, a senator here in Dublin, in Ireland, and he will talk about the education system, the Irish education system, and the challenges ahead. That is on the 1st of June. Mid-June, we have our financial service group with a seminar focusing on financial regulation. That will come up soon. The exact date and the topic will be mid-June, so keep a note on that. And finally, on the 30th of June, we have the topic renewable energies with the focus microgrids. Now, I like to mention Helen Dunn, who invited you. If you have, let's say, more need of information, or you want to know more about our events, please go to our website or talk to Helen Dunn directly. Before I come to Christian, one word on our procedures for today. Excuse me. We have a question and answer session as usual, and please use your toolbar on your screen and type in your questions. Please don't wait till we open the question and answer sessions. We collect all the questions during Christian's presentation, and we will make sure that your question will be highlighted. Thanks to Christian, he gave the permission that we have the presentation and this video presentation on our website, so you don't need to take notes. So without further ado, I like to hand you over to Christian, and I'd like to give you a few words on Christian's career so far in his bio, that you understand a bit his background. Christian is Managing Director of Economics Research within Barclays Bank, and before he joined Barclays, that was in 2007, Christian worked for the International Monetary Fund. And he has worked since 1999 with the Monetary Fund, and he worked in Turkey as one of his places. He's now based in London, and within the Monetary Fund, he was working mainly for emerging markets in Europe, Latin America, Asia, and other places. He studied in Cologne, close to my hometown, Wuppertal. Has a PhD in economics and a joint MA in economics and finance from University of Cologne and AHK in Paris. So without further ado, Christian, please enlighten us on the future of Europe.
Thank you very much, Rob. Thank you for the kind introduction, and thank you for the opportunity and all those involved making this happen. I'm very happy to talk today a bit about the outlook for the global, and I guess given the audience in particular, also about the European outlook. And you know, it's obviously not the usual outlook presentation you give at the end or the beginning of a year, where you talk about variations of growth and you know, small changes to policy, but we are obviously in, I think that's fair to say, in a once-in-a-century crisis. Interestingly enough, I probably would have said that 10 years ago when we had the global financial crisis, but I can tell you up front that this is actually, from an economic perspective, it's actually worth what we are having now than what we had 10 years ago. Let me try to move the slide. Sorry. Ellen, are you there? It's supposed to, it sometimes takes a few seconds for the slide to move, but should be moving now. There it is. There it is. Okay, so look, what I walk you through right now is, broadly what we are seeing currently, how we think about the recovery, and then going a little bit about the details on why it could be different this time than in past recessions and what to watch out for. First of all, whenever you get to situations like this, I like to look at the really long term. We are living in a period where very many things that we observe are actually first ever. It started with the last crisis when we saw things in monetary policy we'd never seen before. And this time we're seeing a contraction of economic growth that we have never seen before. I have the timeline here. You see it going back to the 1870s. You have to go back all the way to 45, 46, and 1945, 46 to get a contraction similar to what we are forecasting for this year. We're having global growth now for this year around -4%. To give you an impression, global growth, the way we measure it, in 2009 was only slightly negative, because China, of course, had a very large positive growth still, while a lot of the other economies contracted. Now we have a contraction around the world. China is still positive, but a very small number, meaning we're having now a global contraction this year that is something we have not seen in post-war history. We then see a relatively swift recovery next year. And, obviously there are some question marks around it. And this is exactly what I will be talking about today. I'm sorry about this. I have to find maybe a way of clicking sometime before I want to change the slide. So yes, look, again, just to give you that impression of how bad things have been, and your business people, I mean, you probably saw it in your own numbers, but as an economist, I can tell you I've never seen, many of the time series plunging as deep and as abruptly as they did. And, you could, of course, argue we should have expected this if you have a mandated stop in activity, which essentially what lockdowns were. But nevertheless, it was always still extremely surprising to see data the way we saw it. And this is just to show you on the left-hand side, you saw the PMIs. It happened in China, obviously, 1-2 months before. And then we saw it happening across the world, Europe, US, UK, Japan. They all fell down. And then we expect now them to come back. China is actually already coming back quite nicely. And that's what you see on the right-hand side. This is how we see growth dipping in the second quarter, already negative in the first, very, very deeply negative in the second, and then coming back in the third and fourth. And to some extent, that is mathematically actually quite obvious. Once you have such a negative number, the moment you get a little bit of growth, you're obviously getting relatively large increases. Let me see the next slide. These are the numbers which some of them I mentioned, but just again to give you an impression of the, if you want, of the brutality in a way of this recession that we're going to see this year. Globally -5, and then just to go quickly through it to give you ideas, we see the US 6.5, Japan close to 6, UK -8, Euro area almost -10. I do believe, by the way, there's some reason to believe that it may not be as bad, but we get to this later. But overall, if you look at the emerging market countries as well, China is growing 1.3%, but China has not been growing less than 5% for 3 decades. So, this is something extraordinary, and a lot of the other emerging markets actually contracting quite deeply, including the large ones like India, Russia, Brazil. And despite the fact that from now on we should see recovery, it will not be enough for the year as a whole to make it up. And that we see then is in 21, however, we should get a relatively swift recovery. And as you can see, you know, we are not far away from, you know, what the consensus at the moment is forecasting, and this is relatively similar. Now, you know, there's a lot of talk about I call it the recession alphabet. You know, whether this will be a V, a U, an L, a W. But the best way to look at this is really if you look at GDP in a level terms, and you see it there on the left-hand side, you know, we basically have something that does look like a V. And a lot of people say, oh, we won't have a V. But if you look at it purely, you know, mathematically in this line, we're going down in growth. And then by the end of next year, according to our forecast, global growth in dollar terms, you know, level terms would be back where we were end of last year. However, if you think about it, where growth would have been if we had continued on the path we were on, we have of course, an output loss, which we probably never catch up. And that is, it's a hypothetical loss, but, you know, it's a loss. If we had gone without Corona, we probably would be, by the end of next year, $11 trillion richer in the global economy. And I have this slide on the right-hand side that shows you that, unfortunately, for advanced economies, we think the rebound will be less quickly. And therefore, you know, actually there we will not be reaching the level of 2019 by the end of next year. It probably will take us another year or so, simply because we don't have the large increases in next year. And what I want to go through now is some reasons why we believe actually we should have a relatively robust recovery. And there's a lot of research on recession and recoveries. And, you know, a few lessons to be drawn are, A, if you don't have a banking crisis, recoveries are typically better. And we just had a huge banking financial sector crisis in 2008-9. And, you know, that shows you what how a long recession and a weak recovery looks like. Because once you have a banking crisis, balance sheets, in particular by banks in the financial sector, but many others too, need a lot of repair. And that takes time. During that period, banks are not able to lend. Everyone is in a risk-off mode. And you have a situation whereby typically it takes a long time. And we are in this mindset because most of the crises in the past, past decades were always related to the financial sector. You know, it was the global financial crisis. It was the dot-com bubble. The Asian financial crisis. Russia involved as well. And it was typically the financial sector that drove it. This time, obviously, it's not a financial crisis. And I show you on the left-hand side, you know, banks, as much as people may still be concerned about them, but banks went into this with very healthy capital ratios. And obviously, in the last 10 years, that's what regulators wanted to do, make banks safer. And banks have a lot of cushion this time going into this. So very clearly, it's not a financial crisis, at least not yet. If you extend it at some point, everything becomes a financial crisis. But at the moment, this crisis is clearly one where the banking sector has been quite robust. Now, second lesson from past recoveries, if you have a lot of monetary policy response, that should help the recovery. Or not only monetary, I would say policy response. And we have this time a policy response that is as unprecedented as a recession is, in the sense it's super large, it's very quick and very aggressive. As one example, you see on the right-hand side, this is in a way what's happening at the moment to monetary aggregates. It's a reflection of the radical monetary easing we're seeing across the world. And you see it on the left-hand side here in the new chart. Interest rates, over 60% of interest rates, emerging and advanced economies are below 1%. Very few countries in the world have rates that are above 5. We have a lot of countries now below 0. And on the right-hand side, you see obviously maybe the most extraordinary development, and that is the expansion of central bank balance sheets. We see now the ECB by the end of next year, a balance sheet of 60% of GDP. The Bank of Japan already is at 120 or so, but also the Fed, which had a balance sheet that was declining, massively expanded it again, Bank of England as well. And that explains why you have this massive increase in monetary aggregates. So, very, very big monetary policy response. We can talk later about what consequences it may have in the longer term, but for now, obviously, it's something that definitely has helped to boost markets, which you obviously see if you have a look at the equity market and other markets that have responded quite well despite the crisis. And of course, on the fiscal side, I don't need to tell you this, we have seen a mass of programs to support companies, and now we're seeing a second round of programs that thinks about the recovery, boosting demand as the economy goes into the second half and into next year. What I have here on the chart is based on some IMF calculations. We're trying to update this as much as we can, but frankly, we almost cannot keep pace with the developments. Overnight, we saw obviously out of Germany another package worth around 3.5 to 4% of GDP. This will add to the number that you're seeing here, and you see that the programs took different forms. Some of it is real spending from the budget, revenues, or more expenditure. Others are guarantees and stakes the government takes in companies. But as I said, Germany, for example, you see on the very right-hand side, that dark blue line of direct spending has now increased a lot. So, on a G20 level, it's more or less 50-50. Half of it is loan and guarantees, and the other half is actually budget spending. And you see it's around 10% of GDP globally. That's around another 10-11 trillion. Massive policy response combined with a massive monetary policy response. And often, it may not have been explicitly coordinated, but it's actually, you could call it spontaneous coordination, because a lot of central banks more or less have told the government, look, spend as much as you want. We just buy it and take it on our balance sheet, so you won't have any problem in financing it. That is something, again, that is really unprecedented, and it hasn't even taken place in this form during the global financial crisis. Now, this is, just let me wait till till hopefully the slide shifts. Yeah. So this is why we are relatively optimistic about the recovery. And again, this is, I will go through this fairly quickly. This is just to show you how to think about the recession. There is, of course, the idea that in a very strong V-shaped recovery, and that you see on the left-hand side, you get back to your previous GDP trend. And this has happened in the past in a few cases, but this is unlikely to happen given how much output we lost. What is more likely that what happens on the page next to it, you recover and, it can be a V, but you never get back to your hypothetical past where you had been before. And, I think this is where we're looking at this time, a relatively swift recovery, but never making up for what we lost because it was just too much. And, next page, you see, a number of examples here. Thanks, Alan. I think you overtook that. That helps a lot. I think so. Here you see a few of these. No, next page is good. Perfect. Yeah. Here you see what I call the recession alphabet. We have examples in the past of V's, U's, W's, and L's. And as I said, I think this time we will have somewhat of a V. It may not be as strong as the example here, which is Canada during the global financial crisis. But I think there's good reason to hope that it's not going to be, for example, the L-shaped recovery that Greece saw, where essentially you don't recover, or it takes a very, very long time and a very, very slow way to recover. There's a bit of a risk of a W, which you see on the bottom right. What the US saw in the early 80s. If we should get a second wave and you suddenly, activity slows again in the fourth quarter. But we can talk about it in a moment. I'm quite hopeful actually that that will not happen. I move to the next slide. So and yeah, thank you. Now I gave you in a way our baseline and the reason why one has good reasons to be quite constructive. Now I want to spend the next few minutes to say why, why we do have our doubts and what the risks are. And the problem is that this time may really be different, and it's because of the size and the nature of the shock. Now the size I already told you about, unprecedented contraction of the economy. The nature, I said, is a good thing because it means it's not a banking crisis, it was just a health crisis. And in principle, that should mean that once the health crisis is over, the virus is gone, we go back to normal. There are, of course, a few doubts whether that will happen or whether we have to live now with a constant fear about pandemics, which could mean we have some longer lasting structural problems. And here's the issue. What you see on the left-hand side here, it's a very important chart. It's unemployment. In the last 2 months, the US has seen 40 million people going unemployed. We expect the unemployment rate for May in the US to be 20%. Germany came out yesterday, it's just 7% unemployment. But what you see on the left-hand side, I just assume for a moment that all those 7 million people in Germany being on short-term work, just for a logical second, assume they all have been unemployed. If we hadn't the program, Germany's unemployment rate now would be also at 20%. So that shows you that the employment shock is actually, it's quite similar. It's just we have very different institutional arrangements on the labor market, how to deal with it. Now, this is a huge issue because the question is, will these people quickly go back into their old jobs, or will we have a situation whereby many of them will remain unemployed? And a lot of this has to do, for example, that you see on the next slide, is that small and medium enterprises are still very important to create jobs. We talk a lot about the Amazons and we moved already to the next one, but when you later look at the chart again, what you see is in this world, even in these advanced modern economies, Japan, Germany, still 60–70% of jobs are actually in small, medium enterprises. A lot of the jobs are in the micro enterprises, one-man shows, so to say, restaurants that just have a few people to work with them. And, if you do not see these companies coming back, and now if you go to the next slide, thanks, Alan, you see that among those companies, this is where we see most of the bankruptcies. And of course, most of them are, you see this on the right-hand side, in the sectors hospitality, professional business services, etc. If that doesn't come back, you will have millions of people who need to find new employment and probably won't find it with their own employers, but need to find it somewhere else. And that, is a massive reallocation problem, as we would call it in economics. And, it means that it will take more years. It is not a matter of months or quarters, it's probably a matter of years. And also the government programs then have to switch, because it's no longer about protecting people in existing positions and paying them to not work, but you will have to incentivize them to look for new work, you have to train them, etc. I stop here, but that, I believe, is a key question. And if we move to the next slide, I want to show you why it is a big question, not only for, of course, the households who will suffer through this of not having a job, but because the way they will react. And the way they react is they will not spend. And the money they have, they will save. This is what you see on the left-hand side. US personal savings rate has already jumped. It will probably go higher. And in Europe, we have only quarterly data, but our forecasts are that we see a massive increase in the saving rate. And at the moment, it's natural. If you cannot go out and spend, if you cannot go out in a restaurant, you stay at home. What can you do with your money? You reduce your spending automatically. But the question is, how quickly will that turn around again? I think, by the way, just as a remark, the fact that Germany lowers their VAT as part of the new package is a good thing, because it should incentivize people to spend. So it is quite well engineered to try to ensure that the savings rate doesn't stay high forever and that people go back to consuming. Can we go to the next slide? So this is I think this is in a way the crucial question. And I also show you this chart. It's also a long chart. So in the beginning, I showed you, over 150 years of growth. Now I'm seeing you show you 150 years of debt levels, government debt levels in the G20 economies. And what I want to show you here is that we never had debt like this in peacetime. And, it just made another huge jump, as you can see, this and next year. And, the question is, how will households react to that in general? How will, private agents react to this? May they tell themselves, well, all this debt, what will happen? Will it make them cautious? May they anticipate future tax hikes and start saving more? And also, will it slow down the economy overall for other reasons? That governments at some point, if they can no longer, finance it through the printing press, will interest rates go up, etc. It's something we don't talk about now. And every policymaker, every central banker tells you, don't worry about the debt at the moment. Interest rates are low. There's no inflation, so let's not worry about debt sustainability. And I agree with this. At the moment, it's the right thing to do. But again, sometimes looking at these historic charts is worth something. This is an extraordinary development, and we don't know how things look in 2 or 3 years from now. Next slide. Thank you, Ellen. So our baseline. I told you now what I'm worried about, and I tell you now what I'm kind of looking at for now to at least get an idea of what the short-term developments are. And look, it's quite simple. You have to look at now, what is activity doing? How quickly are jobs coming back? How are people behaving? Do they go back to normal behavior quite quickly? And then, of course, last but not least, the virus itself. And this is really a number of charts. I just want to show you all the things we were looking at the moment. In this crisis, we found a number of ways to trying to track high frequency indicators, all kinds of things, Google mobility, pollution in cities, traffic, just to get an idea in a way how bad activity is affected. And what you see on the left-hand side is a nice idea from the academic colleagues at Oxford. They have this Stringency Index, which shows how stringent lockdown measures were. And obviously you see all over Europe, including in the UK, it has been coming down. And immediately on the right-hand side, you see that mobility is moving up. And that's a good indication for activity coming back. And we see this all over. And we're measuring this, if we go to the next page, for example, in the, Ellen, can you help me? Thank you. Yeah, then on the next page, you see, for example, on the UK, with the Barclays data, we have a very good ability to anonymously, obviously, track all the spending. And, we've seen a very swift recovery already in May of spending. And as you would think, in food, it's already up. In transport, it's still quite low. But, we observe this in the UK. We see in the US, it's quite complicated. We have 52 states. The states have opened up at very different speeds. You see that, Georgia was, it's an odd state, but, it's one of the states that opened up already 4 weeks ago. So, it actually showed a quicker, quicker mobilization of people, if you want. The jury is still out because in Georgia, most recently, actually, the case numbers of the virus have gone up again. So, this is something now we have to watch. Opening up of economies, which brings back activity. And I'm pretty sure over the next few months, we're going to see a number of possibly upside surprises because people, Ellen, if you go to the next slide, people got very used to, seeing very poor data. And, now what you saw, for example, here in China, it's a very good indicator because China is obviously a few months ahead. And they have, of course, a different nature of an economic regime. But what you see here on the left-hand side is that is very typical. You basically see production in China went back up, but the export orders are very weak. Why? Because the rest of the world is still in recession. China was just ahead. But what is encouraging is when you look on the right-hand side, as the rebound in services in China. And services suggest that's mostly domestic demand. So China is managing actually to grow its economy on a revival of domestic demand. And it means that apparently Chinese, for example, are not greatly affected in their behavior from the crisis. We hear that shops are full. There's anecdotal evidence, in particular luxury shops. People are keen on buying the most expensive Hermes bags, etc. So the idea that maybe the consumer would, for longer term, be shocked and not go back out, at least in China, that's not the case. And it maybe gives you an idea that it may not be in other countries as well. If we go to the next slide, you see in a way what we expect now globally. The global PMIs, you see an interesting difference between manufacturing and services. So manufacturing is a lot of times optimized. So in principle, you can keep keep production running with a lot of robots and with few people. They can work in with bigger space between them in the factory. You can run actually manufacturing production quite well if there's demand. But on the service sector, obviously, you have a lot more need for face-to-face interaction and closeness, social closeness, if you want, and that sector obviously was mostly hit. And so we're observing now where all these are coming back. You see this on the right-hand side. Everywhere we saw the big difference between manufacturing and services. This is coming back, and if China is any guide, we would assume that this continues over the next few months. Obviously, with the exception of a few sectors, tourism probably will not not be as it was last year, given that there are still a number of restrictions. If we go to the next, and I believe the last slide, I would like to actually conclude this. Not yet the last slide. This is the next thing to watch, and I mentioned it earlier. The virus. All this is based. All what I said is based on the assumption that the virus does not come back in a meaningful way. And you see on the left-hand side, China, the yellow line, it peaked and has been down for a long time now. Italy was very prominent. The orange line looks like a very classic virus curve. Went up, peaked, and then came down. This is how, if you look a little bit at pandemics on general epidemiology, this is how virus curves look. The same Germany, France, UK is coming down well. What I'm a bit concerned is about the US. The curve plateaued, but it doesn't really come down as we had seen it in Europe. And this is because some states like Georgia have opened up early, and it's not clear whether the curve is really behaving the way we would like to see it. The US can maybe live with 30,000 if you look at it, 30,000 a day, but it still means that the virus is not really coming down, and the R values are not coming down where you want them to be. And more concerning in particular also is if you look at the right-hand side, I have a bunch of emerging markets. Of course, Korea, in a way they went together with China, close to China. They're at the peak and now they're down. But countries like India, I just talked to colleagues in Mumbai yesterday, India is still rising, Brazil is still rising, and these countries were not willing to impose the same rigid measures. Maybe they couldn't even in terms of organization, but and they of course now suffering from this. And this is it shows that the virus really is not, it's hard to say whether it's really something we can put to the history books, or whether it's not something that couldn't come back. And now we go to the final slide, because I want to leave it in a way with an outlook, an open outlook. Something I mentioned earlier, will we go back to normal? And in a year from now, maybe we have another seminar and we kind of look back and say, wow, wasn't this a crazy time? We were all worried about a virus, and ultimately, we all now have a vaccine and the virus is gone, and we're really living the same way we lived in 2019. Or is this something that will leave scars and we will permanently behave in a way as if there's always a risk of a pandemic coming back, the coronavirus or something else? And we already see some trends here where countries are saying, let's bring some production back, let's reduce reliance on global supply chains, in particular reliance on certain productions in China. We need to create more resilient supply chains. You know, and we already see, again, I show you this chart, and that is in a way my my ending here. You know, we have seen over the last 150 years, you know, globalization. This is just showing global trade as a share of global GDP going up and down. And, you know, we already plateaued with regard to globalization before the global financial crisis. We now have come down a bit, you know, but overall, you know, globalization still continued to work in a way as it did before. I think what we could see is some trends now being reinforced of reshoring, of, you know, maybe moving out of China, etc. And, you know, this is just, I think, one of the issues that could create longer-term structural changes to the economy, which, again, would probably imply that it takes some time to reallocate resources. That typically means that it slows you down in growth a bit. But it also could have many, many opportunities as well for businesses, as well as challenges for some. And obviously, and that is my last word, I mean, this is the Irish-German chamber, both economies that are very open, that very much benefited from globalization, and yeah, probably have an interest in it to at least continue in a certain way. And with that, I hand it back to Ralph. Hello?
Hello, yes. Can you hear me or share my webcam?
I hear you well, Ralph, yes.
So I'm back, okay. Yeah, first of all, a big thank you to you, Christian, for your presentation. Feel like that you have received now a huge applause from our audience, as I have mentioned, around 100 people. And you can see that your presentation was received very well, because there's a lot of engagement. I'm just checking here our questions. We have more than 8 questions already, or kind of questions, keywords and topics we like to share with you. To you all, ladies and gentlemen, as usual, we try to finish at 11 o'clock Irish time, so that we have 1 hour altogether, as we used to do, and we will manage to do that today as well. So without further ado, I come to a couple of questions or keywords. One keyword comes up is inflation. So you maybe say a few words on that topic. Is that a risk?
Yeah.
What will happen in the future? What is your view?
Yeah, apologies that my presentation went a little bit longer than I intended to, but look, I would say the following on inflation. Right now, there is none, and all the tendencies we see are deflationary, you know, because we have this huge demand shock. Now, there's a lot of worry about what could happen later on, and you know, I do share some of it. We have to think of inflation, I think, in terms of supply and demand, and what we have seen over decades, not only now, is on the supply side, you know, we have reasons to think that inflation stays low. We had globalization. We brought hundreds of millions of cheap Chinese workers and others in emerging markets into the global production that lowered wage costs. So we no longer have these wage cost pressures like in the 70s. That has been going on for some time. We have automation, very important, you know, that puts a lot of pressure also on the whole negotiation of manufacturing wages. And, you know, while we may change some of the supply, you know, if you say we are closing down production in China and bring it back home, maybe we have to pay higher wages. My assumption would be, though, it will lead to higher automation. At the same time, commodity prices, maybe oil comes back a bit, but it seems technology everywhere is creating sufficient supply. Now, on the demand side, we obviously now in a crisis, so demand will not drive inflation. But look, what we could see is maybe in 2 years or so from now, if monetary policy remains very expansionary and you essentially print money and hand it out to people, at the same time you create maybe some supply side bottlenecks. Could inflation come back to some extent? Yes. Am I afraid of a, you know, kind of a really high hyperinflation scenarios? Not really. And I think this is why, you know, as astonishing as you might find it, you know, inflation didn't even feature in my presentation. because I think at the moment it is not an issue. It is not an issue. But yeah, a lot of the policies we're doing are extremely unorthodox, in particular on the monetary side. And I wouldn't say that it's impossible to create inflation if you are radical enough.
Okay, thank you very much, Christian. Another topic, you mentioned the potential longer-term structural changes for the global economy as a consequence of the pandemic. Can you elaborate on that? And maybe to combine that with another question, one of our guests today mentioned renewable energy and mentioned the Green Deal, Europe, and all the incentives coming from Europe. Could be renewable energy or the whole energy efficiency sector. Could that be a driving force in the future? And your overall view on structural changes?
Huge issue, but let me go very quickly to a few of them. I mean, one I mentioned at the end of my presentation. I think we have a bit of a rethinking now, and this will be driven by policies, because countries want to, have some production, essential production when it comes to healthcare at home and accessible. But I think also shareholders will probably press some of the large companies asking about the resilience of their supply chains. And I think there will be, the motto will change a bit. I think, it will go from pure efficiency, maybe a little bit more to resilience. And, I think someone put this in the words of, it will move from just in time to just in case, meaning, we probably will have at least a diversification maybe of supply chains, some more automation. I think that will happen. Unfortunately, some of it will also be driven probably by geopolitics. I think the China-US tension, and also with Europe and China, has only intensified as a result of the crisis. So I think that's one development. This has been largely, so far, the deglobalization trend has been largely on trade of manufacturing goods. I think what hasn't been affected so far at all was obviously the movement of people and the way we have been easily traveling. More and more people have been participating in tourism. One of the biggest developments of the last decade was really the massive increase of Chinese tourism, tourism worldwide, education, people going to other countries to get educated. Now, if we have more travel restrictions and travel becomes more difficult, I think this is one of the big, possibly lasting challenges and changes, that we can no longer easily travel around, which was something that even the anti-globalization movement has never really been against, and that's new. It may also lead, third point, maybe to some less agglomeration. Despite the fact that we had already a digitized economy for the last 10 years, people still wanted to be in the place where everyone else was. In Silicon Valley, everyone wanted to be in Silicon Valley and San Francisco, even though they were developing systems which would have allowed them to work in the Rocky Mountains and communicate the way we communicate now. But people didn't do it. They still wanted to be in the same place. I think, now that we saw that this is possible, I think people still want to meet each other. But I do think they see now some of the, they probably see some of the, negative side effects of agglomeration, being in a big city, relying on public transport and being very exposed to, for example, health risks like a pandemic. And so that's, globalization, it's international travel, it's agglomeration, big cities, I think become maybe a little bit less attractive. And I think lastly is exactly that Green Deal and general green policies. We see it not only in the EU. We saw just yesterday, I don't know who heard it, a big speech by Johnson about a green recovery in the UK. I think people took this crisis as another sign that we have to be more aware of, in general, of nature. And I know this is very broadly speaking, and what we saw now, the pandemic has nothing to do with climate change, but I think the perception that this shows our vulnerability to exogenous shocks that have to do with nature, with climate, pandemics, I think has only grown. And I think it is very true that this will now be something that will be more pertinent. And, we do now live with bigger governments, more debt, more government programs. Governments are now bigger and they will play a bigger role. And that means that investment processes will become more political. And if the policies go in that direction, I think, we probably have a lot of direction of investment as part of the recovery into green policies. You saw it in Germany, the Cash for Clunker program only supports electric cars. So, that is just a first indication of that.
You mentioned travel already. If we talk about questions come in regarding supply chain, in a nutshell, the freight costs, will they go up or will they go down? The demand is comes decreasing. What is your view on that?
It's a good question. Look, in principle, the cost should not go up. Oil has just become cheaper. The capacities are huge. If you look at the fleets we have built up during the boom of globalization, airlines have excess capacities. So in principle, it shouldn't go up. Now, make the link to that is a normal supply demand question. Now, if you bring in green policies, and there would be a decision, for example, which is already being discussed. I mean, if you follow at least in Germany the domestic discussion, why aren't we taxing kerosene? Why is it possible to fly from Munich to Hamburg for 18 or 19 euros? If you talk to certain politicians in certain parties, there's a lot of ideas in a way to make travel, in particular air travel, more expensive. Now, if that became something global, supply demand doesn't matter. It becomes then an exercise of trying to internalize the external costs of travel and freight. And, I think that may make it more expensive then. But I'm more concerned, honestly, when it comes to person travel, that it will be more complicated because of of the pandemic fear of not being able to sit as close together in planes, a lot more controls that will slow things down. For freight, commodities, I don't think it should go up. But this is really a kind of an ad hoc attempt to answer the question. I've not have dedicated research on it.
Thank you very much. Another one, SME sector. It's something what happens in Ireland, but in other countries as well, that a lot of SME companies will be supported, financially supported. And the question is, would it be better at the end of the day not to support such amount of SME companies who might not be so competitive in the future anymore? In other words, that is a clean up, if you speak very hard in hard terms here. That is one of our guests asked in that regard, what you do with SMEs, too much money, or what is the right level?
Now, first of all, as I showed in my slides, SMEs are responsible for a large share of employment. We must not forget this. This is, I think, the reason why the support was out there so quickly, is you saw that even in places like Japan, Germany, where you think, you have all these large companies, global companies in mind, 70% or more is still of the employment is in SMEs. Now, the question behind this is an interesting one. There's always a question of, are you romantically supporting something that is, for traditions or so, but that is really no longer efficient and cannot compete in a modern economy? Look, I mean, the truth is, in Germany, a lot of the SMEs are actually top notch, and they have niches in global in global production where they are the most innovative and the best. And so therefore, it's very difficult to really say as a policymakers, SMEs in general cannot survive or can survive, or I don't provide them the finance. I think in the short term, at least, it was right to support them, because what they do not have often is the same access to capital markets. And so large companies, I don't need to name them, but the large DAX companies in Germany, they easily, in a way, obtain bridge financing. They can issue bonds. The bonds are being bought by the ECB, by the way, and therefore they can survive. While I think in a crisis like this, to provide bridge financing, that is correct. Now, longer term structurally, I think it is a challenge. It is true that we then have to think can we artificially keep alive companies that are no longer efficient? And I just add one thing that just comes to my mind. The OECD did a study why productivity is so low in Europe and elsewhere, by the way, as well. And one reason is that there's not productive companies. There are productive companies, but some of the companies that are not productive are being kept alive, and they're so-called zombie companies. And they're being, if you keep them alive, your general average productivity will not go up. So look, I don't have an answer. I think one has to be very careful that we don't go into something where the government becomes too powerful and decides over entire sectors whether they live or not. But I would assume some of it may be more in the micro businesses, by the way, not only SMEs, but really a lot of these very small restaurants and places that were really run by just a family. It seems that they may not be as good in a position as some of these large chains to kind of optimize their processes also from the new standards that may be set now in a post-pandemic world. I stop here. Again, not a conclusive answer, but definitely one that I think is very pertinent.
Mm-hmm. You mentioned already the let's say extremely large policy responses from different governments and the EU and so on. What are the risks associated with it? Because there's a huge amount of money now going out to different instruments, to companies and so on. What would be the risk of it, or do you see any main risks in that regard?
Well, we now have debt ratios on average, in many countries now over 100%. In the US, it will be way over 100% for the euro area as a whole as well. There were times when, when I was still at the IMF, we wrote papers, and there were famous academic papers about the idea that once you reach over 90% debt to GDP, things would go very bad because there was a debt overhang. High debt would slow you down, would make growth weaker. This was, of course, always under the idea that you would crowd out private investment, the interest rate would go up. We live now in a world where real interest rates are very low, and they're very low because there's a lot of savings around, and productivity is low, and we don't have inflation. If that continues, I think we can live with a higher debt burden. The risk is, I think, as I said earlier, whether there could be a situation where inflation comes back, and at that moment, then central banks will face the question, do I actually now do something against inflation, raise interest rates, which we can't really afford because many countries cannot pay or cannot service their debt with a high interest rate. And what I would assume they won't do it, they wouldn't raise interest rates. This was what markets, by the way, pricing as well. They leave interest rate low and let inflation in a way deal a bit with a nominal debt burden. And that is one way how you deal with high debt. Right? If you don't want to restructure, you inflate it away, and you do a bit of financial repression. And obviously that is that works to some extent. But if inflation would go too high, that's a big risk. So that's I think the main issue here. And the second one is that it's our political economy. We did something now in an emergency situation, and it made sense to go out there to give money without checking, with 100% government guarantees, with allowing people to draw money right away. And it's right in a crisis, but it has an impact on incentives. And there's now, I think, a lot of people jump onto this and say, well, that's what I always wanted. And you will now, even after the crisis is gone, have a political momentum into going, well, let's continue to print money, let's just hand out money, and it goes into politics here. And I think one can be neutral about it, but I think one can say that the risk is, of course, that the state keeps growing, and you more and more have non-market mechanisms at work. And there are many people, maybe you say that's the right direction. We had too much market in the past, but there are also reasons to believe that it may actually not be a path that leads us to productivity and kind of best allocation of resources.
Yeah, Christian, thank you very, very much for all of your time, in particular for answering all of our questions, a huge variety of questions, and you gave us your answers, your insight. We come to the end now, so please again feel like that you receive a huge applause right now from our audience. And as you have seen, a lot of people have asked a question. That is always a good sign. And I like to invite you for another opportunity, hopefully more at the end of this year, that we might be maybe come back to you and ask you to give us an update on your view, on your ideas. And as we all know, the COVID-19 situation overshadows everything. From an Irish perspective, European perspective, UK perspective, Brexit is a topic which will come up soon again. And it might be an idea to integrate that in your perspectives. And we're looking forward to seeing you more at the end of the year again for a presentation. So again, thank you very, very much for your insights today. And ladies and gentlemen, we are now at the end. It's exactly 11 o'clock Irish time, so we're delighted to finish now on time. We wish you all, on behalf of Christian, myself, and Helen, my colleague behind the scenes, we wish you a wonderful day and talk to you soon. Thank you very much. Bye-bye.
Thank you, Ralph. Bye-bye.
Thank you, Christian. Christian, we just wait a second. Helen has to disconnect us, so could be that she is still busy with that. She will tell me.
Good.
Yeah, as mentioned again, thank you very much, and hopefully we see each other again later on this year. What is your own view on this? What would be a best time for that if we would integrate Brexit? What would be a good time?